Hey, everybody, welcome to another episode of Money and Stuff. Hope you guys are doing well. I am Sam Rodriguez, certified financial planner. With me, as always, is my co host, Connor Shepard. Connor, how's it going, man?
It's going good, Sam. Ready for the holidays. This is my favorite time of year. So, it's hard to catch me in a bad mood anytime in December.
I'm going to tell you before I say this, I'm a little bit scared to ask you why this is your favorite time of year. I
I
don't
mean,
know
it's
what you're going to say. Hopefully, it's
pretty,
normal stuff, family, things like that. What are you about to tell me?
I made pretty standard stuff. I just love Christmas time, Christmas music, the lights, the decorations, like you said, the family, the togetherness. I mean, it's a nice time of year. So, and it cools down.
All right. All right. No major editing that needs to happen there. All right. Nice. Moral. And of
Smooth.
course, you had to throw something about the weather in there. Yeah.
Always.
Cools down.
Always.
All right, man. What are we doing today?
Yeah. So today, really to cap off the end of the year, we thought it'd be good to dig into some common end of year tax traps that people can find themselves in. And tax traps that sound like they're a good opportunity, but actually could end up costing you much more in the long term.
Oh, man. Yeah. Yeah. How do I want to say this? I get so many questions nowadays about things that people see on social media, like TikTok or Facebook Reels, where they've seen somebody say, you should be doing this, or the secret tax savings that the IRS doesn't want you to know about. Um, those things drive me bananas, right? There's no secrets. Any, anytime you see something that says the secret whatever that the government or that the IRS or that financial advisors don't want you to know about, like scroll past it, right? But how can it be a secret when all tax code is written documents? There's no secrets. There's no secrets.
Yeah,
All right.
that the IRS isn't
All right.
some shadowy cabal guarding information against the public.
Yeah. Right. All right. That's rant over. Let's get into it. Right. So in particular, what we're talking about are 3 TikTok tax traps to just avoid. Right. So we're talking the 3 biggest ones that I see, or most common ones that I see out there, is we're talking about the 6,000 pound vehicle deduction that some people can take. There's the temptation to write off everything just because you started an LLC. And then there's also talking about how charitable deductions, they're not always the big tax savers that everybody thinks they are. Let's just get into it.
Let's do it.
So we'll kick things off with the big one, right? Literally the big one, the 6,000 pound vehicle deduction. And actually, before I get into this, I'm going to say this. These first 2 have to do with business owners. Like, just creating a business is not enough to start having business deductions. You have to have a real business that is trying to make profit, that is actually doing something, providing a service or selling something. You can't just say, I'm going to go start an LLC and suddenly start writing things off. You have to have a real business, like legitimately trying to do business. All right. Second rant over. So, all right, back to the 6,000 pound vehicle deduction. This one gets a lot of attention, especially towards the end of the year. On paper, it looks like a golden opportunity. I'm going to get myself a really nice big SUV or truck. I'm going to get to write it off. But let's break that down, because there's some real pitfalls here.
Yeah, I mean, it's definitely a popular one, especially more recently. I think you see a lot more people talking about it. And it seems like one of those things that people just jump into when they hear about it without really understanding the specifics. So, I mean, what do you see as the biggest issue when it comes to this deduction?
Yeah. So there's really 2 things, right? Number one is, I would say, deduction does not equal free, right? you're still going to have to spend money on this vehicle. And then you'll be able to take a tax deduction for it, which means you won't pay as much taxes. But you still have to pay for the vehicle. It doesn't suddenly mean this vehicle is free. And these vehicles, they are not cheap, right? Like a new Ford F-250 or like Cadillac Escalade, you're probably going to pay somewhere near $100,000, right? That's just buying the vehicle. And then you got maintenance, you got fuel, you got insurance. All those things really start to add up. So it's not just, hey, I can go get this awesome, nice vehicle and it's going to be a business deduction and it's basically going to be free to me.
Yeah, I mean, in regards to insurance, if the vehicle, correct me if I'm wrong, if the vehicle is owned by the business, insurance is more expensive. Is that correct?
Yeah. So business owned vehicles typically require commercial insurance, right? So we all have personal insurance on our vehicles. Hopefully, if you own a vehicle, you have personal insurance. But commercial insurance, it's probably 10 to 15% more than personal coverage. That's because commercial policies, they've got broader liability coverage, so they account for higher usage rates. So when you think about the true cost of ownership, it's a lot more than just what am I paying for this vehicle?
Yeah, I mean, and I think another factor to consider is really, do you need a 6,000 pound plus vehicle for whatever it is you're getting it for the business, whatever? I mean, how does the IRS look at that?
Yeah, right. So yes, we're talking about these 6,000 pound or more vehicles because that's where you can take the deduction. But the more important thing is that for the deduction to hold up, this vehicle has to be used at least 50% for business purposes. Ideally, you would want it to be used 100% for business purposes. So if you're buying an Escalade and you're mostly using it to take your kids to soccer practice, if you get audited, that's not holding up.
I guess instead of talking about who this isn't for, because I'm sure we could come up with a long list of people it doesn't fit, who would this deduction make sense for?
I mean, it's simpler than it sounds, right? It works best for business owners that genuinely need like a heavy duty vehicle, right? You're a contractor, you're a landscaper. So think about someone who's running a construction business. If they buy an F-250 and they're hauling equipment and materials around, that makes sense, right? That's legit. You can document that business expense, but you compare that, say, to a marketing consultant. They buy a Range Rover to impress their clients. The IRS, they're going to have a hard time seeing that as a business expense, and they're probably going to see it more like a personal expense.
So how would depreciation play into all of this?
Yeah. So under the IRS guidelines, right, you can deduct a certain amount for SUVs or, up to the full purchase price, right, for these heavy vehicles that are used exclusively for business though, right? But if you're splitting the vehicle between your personal and business use, you're going to need to prorate that deduction. And here's the catch. If later you reduce your business use, you could face something called recapture, right? And recapture is basically where they say, hey, you've been depreciating this asset, but we see that it's not really a business expense. So we're going to have you recapture that depreciation, essentially throw it back on you or kind of retroactively, but you're going to owe back some of those deductions that you took.
Wow. I mean, I know I wasn't actually aware of that. And that's actually crazy to think that you could actually be on the hook down the road when you think you're off scot-free from it. You could be on the hook to basically pay them back for a part of that depreciation. I mean, what would be the best advice then for someone that's looking at this deduction, someone who's thinking about taking this deduction?
Yeah. So again, simpler than you think, right? You just ask yourself, do I really need this vehicle for my business? If you do not, it's probably best to walk away. And then second, can you actually document the business use of this vehicle? So if you're not prepared to do things like track your mileage or prove the vehicle's purpose, do you really want to risk trying to prove yourself in an audit? And then third, if you're really looking for deductions, I mean, look for the other things that you can do, right? Things like maxing out your 401k. If you're a business owner, maybe you just need to start a 401k or, fund an IRA or maybe an HSA. Maybe take that money that you would have bought a vehicle with and reinvest it back into the business for things that'll help your business actually grow, right? Those are things that help your business, help you reduce your tax expense. Again, don't just think, man, I can get a really big, nice vehicle and pay a lot less for it because of the big deduction that I'm going to get.
Yeah, I mean, that makes sense, right? I mean, it sounds like a lot of things in our industry, right? This isn't just a blanket solution for everyone, right? It's a tool that you can apply in specific situations to specific circumstances that it can be very beneficial, but it isn't just a one size fits all solution.
Everything out there, right, is a tool, right? We say that about different financial instruments all the time. Like, things aren't good or terrible. They are tools that are appropriate in certain circumstances. They could be terrible in certain circumstances, and they can be good in certain circumstances. And tax deductions, very similar to that, they are tools. They are not shortcuts. You have to know how to apply them. You got to know if they apply to you, right? And they can help you save on taxes. But if you abuse them, you could end up with an audit. You could end up with a huge tax bill. You could end up having to pay back taxes. You could put yourself in a real bind.
Yeah. And speaking of abusing it, you want to just jump into the next trap?
Yeah, man, let's do it.
So the next misconception that I see this all the time just pop up on, reels and whatnot, but this idea that just because you have an LLC, you can write off anything and everything that you want to under the sun, right? And I would say is probably one of the biggest mistakes that a lot of new business owners make.
Yeah, people hear the term write-off and they think that it's free money, right? But the truth is, just because you have an LLC, it does not mean that every expense you have is deductible. The IRS has very clear rules about what qualifies as a business expense. And again, you better have a legitimate business, not just have started an LLC.
Yeah, I mean, I've seen people talk about writing off everything from family vacations to personal meals to just buying something. Like, they're a YouTuber, they buy something and they put it in a video and just say, writing it off like a car or something.
Let's use meals, right? If you are traveling for work, sure, you can deduct 50% of the cost of those meals. But, you take your date, you take your family, you take them out to dinner, you take your buddies out to dinner, and you call it a business meeting, right? That does not count. The IRS expects your expenses to be both what are called necessary and ordinary, right? So necessary means it's helpful. Not just that it's convenient, but it's actually helpful to your business. And then ordinary means that it's a kind of a common practice in your industry. Like, this is something that, I don't want to call it necessary, but it's almost kind of needed for the business to keep going. So it's very common for these things to happen in your business.
So what happens if someone gets this wrong? Someone definitely doesn't understand what they're doing and they're going about doing this. What's the risk?
Yeah, the biggest risk people are going to face is if there's an audit, right? If the IRS audits you and they find these deductions do not hold up, you're going to face penalties. You're going to owe back taxes. You're going to lose the deduction altogether. Plus, it could be a major red flag for your future returns. So be ready for them to be looking at your expenses even closer in future years.
Yeah, nobody likes an audit. The word, I think, makes everybody start to break out in a cold sweat.
Yeah, the word audit actually kept me from becoming a CPA, right? I know you and I've had this conversation that I went to school to be a CPA, and in all the jobs that I was starting with, they were like, yeah, you're going to start off as an auditor. No, that sounds terrible. I want to do something else.
Do you have, could you give an example of the right way versus the wrong way to apply this?
Yeah. So let's say that you're a freelance graphic designer and you set up an LLC. You deduct any kind of software subscriptions. You can deduct your internet, but only a portion of it. I should say your internet if you're working from home, right? Because some of your internet usage is going to be your personal internet usage. You can deduct some mileage for your vehicle, but the mileage that's used for the business, like client meetings, right? Those are legitimate business expenses, and you need to keep your receipts. You need to keep detailed records. That's really how it should be done. But, you know, kind of contrast that with someone who claims, their new, huge leather couch as a business expense because they sometimes work from the house and work out of the living room. That's not ordinary. That's not necessary. If the IRS comes knocking on your door and they see that couch is in your living room, but you claimed it as a business expense, you're going to have issues. You're going to have a tough time justifying how that couch was a business expense.
So it sounds like you really need to be, it's about being realistic and strategic with how you apply it.
Yeah, this is where you really want to work with an accounting professional and not just take your advice from somebody on social media, right? Before you deduct anything, you need to ask, are these expenses directly tied to my business? Can I show that? Can I prove it with documentation like receipts or logs that I keep? And does it align with IRS guidelines for my industry? If you cannot confidently answer yes to all three of those things, it probably isn't going to be a valid deduction.
That makes sense. And if you have access to an accountant, or if you can talk to an accountant, I'm sure they can give you some great guidance. If you don't have access to an accountant, I'm sure most people have no idea where to begin with understanding IRS guidelines and rules. What would be some good tips for people that are just trying to figure it out?
Yeah, so I'd say start with IRS publication 535, right? It's a great resource on business expenses. But again, I strongly encourage you that the best thing that a business owner that's trying to deduct expenses can do is talk with a tax professional. They will help you identify legitimate deductions, right? You want to avoid the gray areas that could get you in trouble, right? Think of it as an investment in, well, maybe this doesn't apply to everybody, right? But I would think of it as an investment into my peace of mind. I talked with a tax professional once that really wanted to operate in the gray area. And his pitch to me was, I've been audited like 24 years in a row and I've won every time. I was like, I don't want to be audited. I understand saving in taxes, but having an auditor in my house and at my business every year is not a goal of mine. Just tell me what the rules are and I'll stay in them.
Yeah, I would imagine the vast majority of people want to do everything to avoid being audited. And so for someone wanting to maximize the deductions, what's the recommendation?
So stay organized. Keep detailed records of your expenses. Don't wait until tax season to try to figure it out. Don't wait until it's time to file to contact an accountant. They are really busy during filing season. You want to contact an accountant as soon as you open your business. And if you already have opened your business, then as soon as possible. Use softwares like QuickBooks. You can even just create a spreadsheet to track everything in real time. If you don't have that many expenses, you can save yourself the cost and just use Excel or something like that, Google Sheets, something. But don't forget to ask questions, right? Ask the accountant. If you heard something and you want to know, is this legit? Is this something I can do? Double check with your accountant. Now, I can say accountants are probably a lot like doctors and a lot like us as advisors. So when you come to them and say, hey, I saw on TikTok XYZ, don't be surprised if you get a heavy sigh or a big eye roll. But you're paying them. So ask the question, find out, and they'll tell you whether or not you can do it.
Yeah, that makes a lot of sense. I think people ultimately want to think about it in the long term, like a lot of things, right? It's easy to be caught up in what you hear as far as, hey, it's immediate tax savings. This is a way for you to immediately see some benefit, some like deduction or whatever it is on your taxes, but you need to be able to think about it long term, especially as a business owner, thinking about it for the business long term.
Yeah. Just think about it in terms of, if you wouldn't feel comfortable explaining the deduction to the IRS, it's probably not worth claiming, because if it's in that gray area and they look into it, you're going to have to try to explain and justify it. And if that thought makes you uncomfortable, probably best just to stay away from trying to do it.
Yeah, I think that's some solid advice right there. You want to go to number 3?
Sure, man.
So let's get into that last tax trap, charitable donations, which, this sounds pretty straightforward, right? Donate money, donate something, save on taxes, right? Get your taxes lowered. But like a lot of things in the tax space, I would imagine it's not that simple, right?
Yeah, this is another one that makes me absolutely crazy when people say, "Hey," I'm laughing because I'm hoping no one that has asked these questions of us are listening and then have just heard me say, "This makes me crazy when people ask this." That's not how I should have said it. Just know I'm happy to answer your questions when you come directly and ask me. I'd rather be that resource and give you the right answer. It's never a bother to me if you're listening and you've asked me these questions.
It's better to
But
ask than just make the assumption.
right. But this is very similar to buying the vehicle and thinking, oh man, I'm going to get a free truck. It's not, it's like, you still have to give your money away to get that deduction. And you have to give more money away than the deduction that you're going to receive. So it doesn't always work in your favor, right? Charitable donations, they can be a great way to give back and potentially save on taxes. But one of the big things since 2017 with the higher standard deduction, it's really changed everything. A lot of people don't realize that they get no tax benefit from charitable donations that they make.
What is the big shift in the standard deduction?
For this year, like 2024, the standard deduction is $27,700 for married couples and $13,850 if you're single, right? And what that means is, unless your itemized deductions, which include your charitable donations, unless they exceed those numbers, you're not going to get any tax benefit from itemizing. And charitable donations are part of that itemization. So your itemized deductions have to be beyond those standard deduction thresholds. And those standard deduction thresholds used to be much lower, and it used to be easier to cross those thresholds. But since they were raised, there's really not a very high percentage of the population that it makes sense to itemize instead of take the standard deduction.
So contrary to what I think a lot of people might assume, I could write a fat check to my favorite charity and donate it and still not see any impact to lowering my taxes. Am I understanding that right?
Yes. Yeah, that's possible. Right. And, I guess that depends on what you consider a fat check, right? If you're married and that check's going to be like 30 grand, then okay, yeah, maybe. But I wouldn't write a 30 grand check just to try to get a deduction, right? Because you're probably going to end up spending more money on the deduction than you're going to save yourself in taxes. But, I think charitable donations should always come from the place of wanting to be charitable, right? And less about the tax deduction that you're going to receive from it. And if you're going to make charitable donations, be strategic about it, right? So most people are used to giving smaller donations every year, whether that's tithing to the church, or maybe there is an organization that's important to you that you consistently give a little bit of money each month or every year, but it's never going to put you over that standard deduction. So one option to think about is to bundle those charitable donations together, right? So maybe do like 1 year, you do 2 or 3 years worth of donation in that year. So that way you can actually cross the threshold, right? You're still giving the same amount. You're just giving it in one lump sum instead of in little increments over time, and giving yourself a better shot of benefiting from a tax deduction standpoint.
Yeah. I mean, that sounds like a smart strategy. Are there other ways, if there are any, that people can really maximize their tax benefits from charitable giving?
Yeah, one of the biggest ones that we see, and an easy one to take advantage of if you're over the age of 70 and a half, right, is you can do what are called qualified charitable distributions. We tend to call them QCDs, but that stands for qualified charitable distribution. And it lets you donate money to a charity directly from your IRA, right? And the amount won't count as taxable income, right? So it's a really good strategy to be able to donate and never have that money count as taxable income. I'll lay out an example. Let's say that you have a retirement account and you're going to take money out of that retirement account to donate to your favorite charity. Let's say that amount is $5,000, right? You pull that $5,000 out of your IRA, the IRS views that as taxable money. Well, then you say, well, I'm going to take that $5,000 and I'm going to donate it to charity. Well, if you do not cross that standard deduction threshold, that donation doesn't help you from a tax perspective. So you're still going to be taxed on that $5,000, even though you donated it. But when you use the QCD or the qualified charitable distribution, it goes directly from your IRA straight to the charity. And you have to make sure you code it right when you do your taxes, right? So in this way, when it goes straight to the charity, it never shows up as income for you. So even though you didn't cross that charitable donation threshold, you gave that charitable donation and still did not receive anything that's going to be considered income in the IRS's eyes.
Yeah,
I'd say a reason that that's an important one is because as you get older, you're going to be subject to required minimum distributions. And for a lot of people, that means they're going to have to pull more money out from their IRAs or 401ks than they want to. And that means that they're going to pay more taxes than they want to. And so this is a way that you can still meet the obligation of the required minimum distribution, but not receive the taxable income.
Yeah, I mean, it sounds like a great strategy, especially for someone in retirement, where more than likely, a good bulk of their income is coming from an IRA. Now, I do have one question. So regarding non-cash donations, because I will say, and I grew up, I can't tell you how many times going with my parents up to Goodwill with a car full of just random stuff that my mom's trying to get rid of and just donating it. And they get the slip from Goodwill and they just look at me and say, this is going to lower our taxes. And I love my parents to death and I'm not trying to talk like they don't know what they're doing. But what is that true? Does that actually work that way?
First of all, Connor, that doesn't sound like giving from the heart.
Better than throwing it away, I guess, is the mindset with it.
All right. But your question is, does that actually help lower your taxes?
Yeah. How do non-cash donations work?
They can be tax efficient, right? Especially if you're doing something like donating appreciated stock, right? So instead of selling that stock, paying the capital gains tax, and then giving it to charity, what you do is you just donate the stock to the charity. Then you get a donation for the full market value of that stock when you gave it to them. And the charity doesn't pay taxes on the gain. And because it wasn't sold while you owned it, you have to pay the capital gain on it as well. So for household items, giving away old clothes, I guess, Connor, just make sure they're in good condition. People don't want your old ratty clothes, but yeah, make sure that stuff's in good condition. Make sure it's usable. Make sure that it's stuff people could actually benefit from. Keep detailed records right? Keep the receipts and valuations of what those things are worth.
So what about somebody that's just giving without thinking about the tax impact? They're actually giving genuinely and not thinking about the ulterior tax benefit of it.
Yeah, hopefully that's what most people are doing. Yeah, right. Like I said that earlier, right? Like giving should come from the heart, right? Not just the tax break. So if you're hoping to save on taxes, just do them. And, ask yourself, will this donation push me over the standard deduction, right? If not, is there a better way to structure my giving? And don't forget to talk with an accountant or tax advisor. They can help you make the most of your contributions.
Speaking as advisors, what's like a common mistake that you see people make when it comes to charitable giving?
I'd say just rushing it, right? Donating at the end of the year without really thinking about how you're doing it. People want to feel good about the giving that they do. It's the holiday season. They want to feel like they're giving back, but they don't think through whether it's the right move financially. Another is not keeping proper documentation of what you did give and the value of what you gave, right? So for any donation that's over $250, you got to remember that the IRS requires written acknowledgement from the charity. And you're going to need receipts for those like non-cash donations that you were talking about. So without that, you might not be able to deduct it at all.
That makes sense. I don't know if I have any other questions. Anything else that you're thinking of when it comes to this?
Charitable donations are more than just taxes. They're about the impact that you're making for the causes that you care about. If you can align that with a smart tax strategy, fantastic. But don't hesitate to ask for help. It's better to be proactive than to miss out on an opportunity or face some sort of surprise when it comes time to actually file your taxes.
Agree more. You want to wrap this one up?
Yeah, let's do it. So I'll recap some key points and lead you with some actionable takeaways. Number one, right, avoid tying up your funds in a massive vehicle unless it's truly a business necessity. Number two, be realistic about what you can write off as an LLC owner. Focus on what's ordinary and necessary. Number three, for charitable donations, make sure that you understand how the standard deduction impacts your giving, right? The key to all of this is planning, and it's important to seek some professional advice.
Couldn't agree more, Sam. And I appreciate you walking me through that because I know even, doing what we do, I still get tripped up by stuff like this, especially when, it's popping up on your video feed and seems too good to be true. So thank you guys for listening and tuning in. If you have any questions, if there's any topics that you want us to talk about, or I think it'd be just something good for us to discuss, let us know. Shoot us an email. My email is cshepard@foundationwealthpartners.com. Always happy to hear what you guys want us to talk about.
Yeah, and if you guys enjoyed this episode, if you stuck around all the way to the end, don't forget to like and subscribe. If you want to hear more on topics like this and you enjoyed the way that we talk about them, please hit subscribe so that way you get notified when a new episode comes out. So until next time, take care. Remember, smart tax moves today can set you up for a really strong financial future. Bye, guys.